And good day. This is the Eye of the Storm podcast with the big picture technical update for the S&P 500 and the NASDAQ 100. It is Saturday, September the 9th, 2023. Basically interesting still in the markets as we continue to attempt to digest what is happening behind the scenes, what is going to go or not go on with interest rates. Where are we within this rate hiking season or cycle or whatever term they want to put on it? I've also got a couple of requests that people are asking for a more detailed big picture update. And so I'm going to start here with the SPX. And I'm going to try to do across the board. So I do it with the SPX, the cash market, and then also with the S&P 500, the ES, the futures market, and then the same thing over in the NASDAQ with the NDX and the NQ. So beginning with the cash market, the SPX. What I'm doing right now is I'm taking a look at the last time we had a cycle degree move that it consisted of an ABC of a primary degree. And that's going to be back starting in 2000, which kicked off with the dot-com bust. Then we had an interim where everything seemed to be okay. Interest rates were fine. Everything was chugging right along. Markets were moving higher. Markets went up back towards the highs of 2000. So prior to that dot-com collapse. So the market had gotten all the way back up. And in fact, during this B wave, the Dow Jones went to a new all-time high. All by itself. NASDAQ didn't do it. The S&P didn't do it. But the Dow did. The S&P came close. In fact, it basically almost equaled that high. And then what came after that? Well, the great financial collapse of 2008, 2009, which actually no one was expecting. In fact, we had CNBC was on the air. We had calls by CNBC personalities, right? Economic or whatever, the experts, basically telling the public, yeah, go ahead and step into Bear Stearns, a great company, don't worry about it. And that was at $109. I think a day or two later, Bear Stearns closed, collapsed, closed, went out of business. Then Lehman Brothers went out of business. And then all because of mortgages. And that's where it started. The massive default of mortgages, the strain that it put on the banking system, what it created for regional banks, what it created for the entire banking system, but savings and loans. It was a debacle. And it created tremendous havoc across the board, not only in the equity markets, but also in the dollar, also in the bonds, also many different factors. Everything got to participate in that big sell-off. Where in the S&P and the cash market, we went from 1,575 up into that area and dropped to a low in 2009 at 666.79. We'll call it 667. So the market lost quite a bit. And it got marked cycle wave 4. But inside primary A, B, and C. Now, what we completed, as I've discussed before, here is a super cycle wave 3. Now, let me just kind of pull this back out, go there, and then go back over here. This move began in 1932. That's where that low came in. The low for supercycle wave 2 was formed and put in 1932, and that low was $4.41. So that's where it all began. Now, what's inside that supercycle wave 3? 5 waves of cycle degree. And we can continue to break it all the way down. But leave it to say that we had this marvelous, fantastic cycle third wave. What was inside that cycle third wave? Well, we had a world war. We had the Korean War. We had a horrible period in the 70s of just this recession, and there's nothing happening in the market, just absolute decline. Then we had the start of a new bull market, and likely was the biggest and largest section of this whole market move up from 1932. We saw interest rates very much under control until we got up to the highs, right? We got up to, this is 1987. Here we have 1980, 1981, which was a period where interest rates were 18%. We had tremendous inflation. We had a run on gold. We had a run on silver, trying to corner the markets, where they all raced higher. Look at them in the market. But it was still, we chugged along. So each one of these rallies, that was the 1987 crash. That's it right there. What's it look like? You know, well, I can't because of the way my system is. But that was the 87 crash. Because under log scale, it's got to crunch so tight that if I try to expand the chart, it just kind of goes nuts. But I can do it right there. That's the 87 crash. So my point here is that many, many things can happen within all of these moves. Okay, so here's the bottom of that C, and then we have the cycle wave 4. Okay. Now, out of that, here we have cycle wave 5. And again, this glorious coming out of there. Interest rates. Now, this is where we dropped into zero interest rate policy, which was adopted by the Federal Reserve, and they held to it. But coming out of this great financial collapse, the federal government, along with the Treasury Department, needed to re-inflate, re-stimulate the economy, cutting the interest rates, getting them down, pushing stimulus into the economic cycle, into the money supply. And that came via large amounts of stimulus being given to corporations under a policy called TARP, which was the payback policy. But along with zero interest rate policy, we started to go. And we went. And we went. And look at that third wave. Beautiful third wave. Now we're into the 21st century, and we just started to climb. There was no stopping it. Everybody was operating on all cylinders. We had a nice little 4. We had that decline in 2019, which was the China trade war. Punishment. And then we rallied strongly, came out of that, hit another high, got us up to February into March of 2020. We all remember what happened then. We got a pandemic. Shut down the world. Economies came to a screeching halt. Everybody had to stay home. It was not a pleasant time. We all were there. We all lived it. We had a superior three weeks, mind you. From March to also March, we had this tremendous decline. And so much time has passed, I can't do it that way. Let me go back out here and let's open this. Look at that decline. This is on a weekly chart. 1, 2, 3, 4, 4.5, 4 weeks, 5 weeks, start to finish, where the S&P capped out at 3,385 and bottomed at 2190. 5 weeks. 5 weeks. That's all it took. And what do we have to go again? Well, still under zero interest rate policies, but we started to cut rates. And now we needed to inject capital and bail out average Joes, the families, the retail, people, so that we could live, so that we can continue to pay our mortgages, pay our rent, buy the food, pay the bills, keep the economy going. And here we went. And rates dropped, and rates dropped, and rates dropped. And corporations borrowed lots of money at 0% interest. And so everything was looking great. We had buybacks, we had everything. Everything was just looking great. And we reached a high. And then things started to catch up, and we finished the whole move. There was cycle wave 5, super cycle wave 3. So what are we doing now? Well, we're in that very first level, or the very first 3 down, and now on a primary degree. So there's primary wave A, primary wave B. I am now, even in my alternate view, which I held, I have now succumbed to saying that's not valid anymore. Outside chance, I'm going to tell you there is an outside chance, but I've restructured the count so that the preferred and the alternate are actually one and the same right now. And so I'm still going to consider that 4607 in the S&P cash market was the high for primary wave B, and we've begun the primary C wave down, which will put in that first A wave, that cycle A wave. Now, let me go back out again. And I guess I'm already there. I just got to pull it open. If I'm going to go all the way back to the last time we had that type of a situation. And, okay, I'm going to go all the way out to the max. Is right here. This is the last time we were in that situation. And now we're basically repeating the pattern, different circumstances. But I wanted to see what started it and what anchored it. The dot-com collapse, the great financial collapse of 2009, 2008, 2009. The A, the B, the C. So again, here we are in our place now. And what are we working on? Well, we got the primary A, primary B. We're looking for the primary C. This was just the fact that the interest rate hikes began. Higher interest rates, higher interest rates. This was in response to, is that enough? Are we still going to get more? Which we did, but now, we had different factors kind of be pushed in. We had different narratives begun. And different types of trading kind of taking place, but still the same basic pattern. So we had the A wave, and then we get the B wave, and now we're into that C wave. Now, what others have also asked me for is like, can I give them some more estimates on what the C wave should do? Well, yep, got that first one out right there. It is Fibonacci extensions. And what we're looking at is we're comparing the coming C wave, which we believe is underway now, is going to be compared to the A wave. Well, C would equal A at 32.89 or 32.90 into that area. C would equal A. Well, we're sitting right now at 44.57 in the cash market. So we're looking for a drop of approximately 1,200 S&P points to bring the market down to the minimum, where wave C would equal wave A. That kind of would be acceptable, but the support zone actually goes further. I'm not necessarily looking for this deep, because on a much larger scale, I have support at 29.80. And I'm going to go back out to show you how I come up with that. Again, here's the whole picture. But I'm running it from that low, 441 in 1932, and I run it up to the high at 4607. Back down again. And we're going to go into it here. So what I'm looking at is that 0.382 of that rally, right, from 441 to 4607, and you can say you work out the math yourself. That first 0.382 support level is 29.80. So what would that do? Well, it does create that C wave to kind of come into an area that I think is going to be more common than just equality. And so our support zone, again, for primary wave C, and then I'm also looking for where wave A, cycle wave A, will bottom. So my process right now is kind of pointing it towards 3290 down to 2980. And there are going to be points in between which we can refine. Now, a total push where wave C would be equal to 1.618 times the length of wave A. That's 2475. Is that possible? Yes, it is possible. Is it possible in a cycle A? Yes, it is possible in cycle A. Now, people want to know, well, what's your time factor on all of this? Well, again, if I'm making reference to the last time we had a cycle degree ABC correction within a primary degree, to put in that cycle degree, it was 9 years. Again, I'm going to go out. Let's take a look. Again, this is the big picture. So what I'm reviewing here is the big picture. That is 2000. That is March of 2000. This is March of 2009. So it was 9 years. 9 years on the nose. That's how long it took to go a dot-com collapse, do a recovery, and then have the great financial collapse. And then we recovered off of that. Stimulus in the trillions of dollars has been added to the money supply, to the monetary system. So what are we correcting? If anything, folks, we're correcting this. But on an Elliott basis, we're going back to the low in 1932 to the high of 2022, and that's what we're correcting. And if it's a wave 4, what's the most common for a wave 4? 0.382. Well, if I took a look at that, that's 2980. Maybe that'll just be wave A. Maybe the whole pattern will be one big, giant, flat ABC. A wave 2980. B wave takes us back, maybe even to new all-time highs. Wave C, once again, drops the market back down to 2980 or lower then. So again, you can't say with certainty, but I can give you the areas. Another thing that Elliott told us, and is useful no matter which degree you're working off of, a fourth wave of, say, a supercycle degree will find its terminus, its end point, within the price territory of the fourth wave of one lesser degree. Well, that's cycle. So we already have, just on an Elliott basis, the possibility we're looking at, what was this number? 1538 to 1667, 667. That's the price territory of the previous fourth wave of one lesser degree. So yeah, it could get all the way down there. Is that what I'm saying is going to happen? No. I'm just telling you, this is what Elliott teaches us, so we have some idea. Now, more important, as you've heard me say often, what comes into play is structure. So we have the fibs to tell us an area, a place where, yep, it's pretty likely that it's going to come down there. The most common or difference between A and C waves is that they're equal. So again, we have that equality, and that comes into 3290 in that area. But then I have an additional fib retracement, right, for the larger fourth wave, and that is 0.382, and that's 2980. Now, mind you, this is forming an ABC, and not that it's flat, because it really, it came in, so 200 points to go before it actually would, that B wave could have been up to there, and then the C wave bringing it back down to here. But coming in here is pretty much going to give us that flatness of this move. Wave C is equal to wave A, and everything else fits in. And then we get a cycle degree wave A bottom, and then a cycle degree B wave counter trend rally. So again, now I'm going to reference that it took 9 years to complete cycle wave 4 from 2000 to 2009. That was a cycle degree drop. And it took 9 years. And it consisted of the dot-com bust and the great financial collapse. A and C, waves A and C. This was interest rates. A very strong cycle of interest rate hikes. A very strong cycle of inflation that may or may not be done. We still have so much more to go. And people say, well, what's going to cause it? It's like, you know what? There are a lot of things that could come up and really steer things in a different direction. If we're taking a look at what could possibly start to contribute to this, we're still going to be battling inflation. It's not over. I know what a lot of people are talking about, but they're going on something that they just really can't step that far out into the future and say, not going to happen. We're not at the 2% level that the Fed wants inflation at. Then we've won that battle. But what happens from there? What happens if they get it there and the next month it starts walking its way back up again? What happens if, for example, we get a nationwide strike, I don't know, United Auto Workers? What happens then? When they go to the boss and they say, we need better benefits, we need higher pay, we need different things. Why? Because they battle the same thing you and I and everybody else does. They got to pay for the mortgages. They got to buy the food. They got to put the kids, take care of their families. Not any different than anybody else. And if they're not getting an equivalent, or that wage inflation is not really making it easier for them to meet ends, well, they're unionized. They go out on strike and shut down car production. What do we think is going to happen? What do we think is it going to be inflationary? Is something seriously going to go wrong? Et cetera, et cetera, et cetera. What happens? Again, there are so many different things. I don't want to postulate, and I don't want to say what if, because Elliott does not ever state something like, well, we're predicting what the economic conditions are going to be like. But you can see the buildup of what starts to happen. Now, what we're hearing is typical B wave talk. And now that we're chugging right along and everybody's seeming to think, well, look, we've got all this great stuff and we have artificial intelligence, the great new thing. We still have a ton of money being poured into the market. You're right. And the only thing that kind of takes that money away is if we correct. And we correct steeply and quickly and without hesitation or stopping. What could cause that? There are enough things, folks, there really are enough things out there to do that now, to really flip things on their nose and stop things. We have a lot of things going on within our own country here in the United States. We have some major things going on in Eastern Europe, obviously. And there are just like a lot of stuff that really could be wiping out a lot of different sectors within the U.S. One of them is, it's like, hey, look at the storms that are coming up. What happens if a storm like Hurricane Lee, which is still out there forming, and went from a Category 1 to a Category 5 in like 24 hours? Now it's coming back down. God bless it. But, different things happen. Are we expecting them? No. How would we? But they're going to be a consequence of what's already happening and going on. So in other words, I don't pretend to say that, oh, yeah, I got to tell you exactly what's going to cause this. But I can tell you what the Elliott wave pattern is telling me. And based on what I can go back and reference, the moves do happen. Those of us that were in the markets, or even in adulthood, so to speak, in 2008, 2009, when People could get loans in the state of California, which is where I live, jumbo loans to pay for their homes. But within a matter of months, these mortgages and the homes were what they call underwater. They owed more money than the house was worth. And then bing, bang, they started to have to walk away. Where are we seeing this now? Not necessarily that type of situation, but on the commercial real estate level. The owners of these huge commercial buildings, and I can only speak for San Francisco, they're walking away from the loan. They're delivering it back to the lender and saying, it's yours. We no longer will take responsibility, nor can we pay it. We cannot meet our obligation. They're giving it back. The ones that have occurred are not just one-off things. There are many, many, not just in San Francisco, but within the state of California, within New York, within Illinois, a lot of the large metropolitan areas. There are a lot of buildings that are in the same position and are going to need to have their financing renewed. They have to refinance these buildings. And what's going to happen when the interest rate is not even close to where it was when they put this together? So there's the one big thing that I happen to think could be canary in the coal mine type thing, except it's no longer a canary. It's an 800-pound gorilla or even bigger. But people aren't even looking at that. What we're looking at, oh wow, look at Apple. They're gonna go up because we've got the Apple big program. They're gonna release iPhone 15. Okay, great. Well, how has it always been? And I tell you, this, folks, is the magic. This is what we fight. This is what the market is fighting. The status quo. Those of us that have a news service, how often do you see where it is talking about, well, gee, if you invested $1,000 in Apple in 1984, what position would you be in now? You would be, probably sitting like Steve Jobs did, or his family now. You'd be a millionaire or however, multimillionaire. If status quo, what's it get people to do? Well, go buy it now and keep it for the next 40 years. You'll be a millionaire. You'll be a billionaire. That's the status quo. That this is the way it always goes, and this is what will repeat itself. Because what do we have? We have history. So what those of us that are like my age, over 60, we can go back 60 years. You can go back and look at the S&P for 60 years and go like, yeah, it's been nothing but straight up. Yep, you had the little bumps and grinds, you had some corrections in there, but if you hung in there, you're retiring with a fat nest egg. What's the guarantee that that's going to repeat itself? Well, they always do. That's called status quo. And my argument is that the status quo is going to get broken because no one's looking. Yep, we recovered off of the great financial collapse, but it destroyed a lot of 401ks and IRAs that did not recover. And now we're 14 years later, and they still haven't recovered. People lost their homes. People lost their savings. And then they couldn't retire. So to say that, oh, it always happens. It always works itself out. That's not always the case. So to hang on to, well, Apple's coming out with new products, so their sales, because iPhone sales should be great. They've already told us they're not going to be expecting the great sales that we've had in the past on the iPhone 15. And guess what? iPhone 15 is likely going to cost $2,000. Not $1,000 or $1,100 or $1,200, but $2,000. How many are you going to sell? People, how much money do we really think that people are going to go out and stand in line just because they have to have the latest Apple product? How much of, China's now saying, we're not going to allow our services and our companies to buy iPhones. They're banning iPhone sales. Oh, how's that going to have an effect? Oh, not going to happen. Now we got this, we got this, we got that, et cetera, et cetera, et cetera. I'm not saying that Apple's a bad company. I'm not saying that Apple's going to go out of business, but I'm going to tell you there needs to be some adjustments made if these things all come into play and stop relying on the status quo. That's my point. Now, back into what I've got to say. The wave pattern suggests we're in a primary C wave down, and that will be completing a cycle degree A wave. The cycle degree A wave, I'm looking for at least like 3290, 3200 with a 2980 strong support that is likely going to complete cycle wave A. Now, what we got coming after that, folks, is before you think, oh, doom and gloom, Michael's just always Mr. Doom and Gloom. No, I'm not. I'm telling you what I see. There will be plenty of things to trade. No, you don't need to sit and hold on with your long positions and watch them melt away and have your account close because you lose your money, right? Because you're on margin or whatever the situation is. You don't need to do that. There are things that you can trade and you can make money on the way down. There will be rallies, even on the way down. It's a 5-wave, intermediate degree 5-wave decline. That's what's going to form primary wave C. So we have intermediate 1, intermediate 3, and intermediate 5 are down. Intermediate 2 is a rally. Intermediate 4 is a rally. So there are going to be plenty of opportunities to do all kinds of things and trade. And hopefully there's going to be enough money rolling around and continuing to roll around that there'll be plenty to trade. You make your money, blah, etc. So, but in any case, I do think we will need to go down and finish this, even though I hear out of my ears too, oh no, we're this interest rate season or cycle of rate hikes is coming to a close. How they now see 2024 as it being a very good year. And I can't necessarily disagree with that because I'm looking for cycle wave A to bottom and a cycle B wave counter trend rally to take over. And yes, I do see it sometime in 2024 is beginning. So, yep, we're all in line there, but we still need to do this first. So to go like, well, they're saying this is going to happen in 6 months. Well, in between that, what do we think is going to happen? Oh, no, we can't have the decline because we're going to rally in 2024. Okay, well, believe what you'd like. So I'm looking for the decline to come down, and it's just beginning. I'm going to bring this down quickly to my daily chart, and I'm going to pull this open. So again, if I'm marking this as the completion of primary wave B, then this in turn turns into not ABC, X, ABC, X, ABC, but 1, 2, 3, 4, 5. It's not the best looking. It's got there was a lot of weirdness in it. Another discussion to have would be the changes, and I did a presentation on this just recently. The changes in how Elliott is forming these waves on an Elliott basis, since we've really turned to algorithms that control our trading, and unfortunately, we have zero DTE options, which are like massively popular and produce a lot of profit and give a lot of liquidity. So a lot of good things about zero DTE. But what the gamma flow can do, you see these massive, crazy moves. And I will tell you when I get over to the NASDAQ, one that I saw on Friday, which worked like a charm, and it was in Apple. So anyway, minor wave 1, 3 waves up, minor wave 2. So in any case, if this were to be the alternate count, and this was showing up as minor wave 4, then this would be what? 1, 2, 3, and this would have been a 4, and there's where it broke. Could not break wave 1, and it did substantially. And it did again, even though they tried to rally it. So that was the kicker for me. I'm going to leave an outside chance that it'll just turn and rally quickly on Monday, Tuesday, and leave this as kind of an anomaly. Or 1, 2, 3, 1, 1, 2, 3, 2, 1, 2, 3, be more of a diagonal. But that's the last hope for this thing getting above 46.07. In the meantime, I'll bring it back down again to the fourth in the 4-hour chart, and we could see 1, 2, 3. So again, it's a setup. If it does not come down and produce a new low, then it's not going to be a wave 5, and this is going to be left as 3. Another product that it could be, still this being 1, this be in the process of 2, but an ABC X ABC. So we still have the potential, but it's not calling for new highs. It's not calling for a bull market. It would be an irregular, not an irregular, but a double ABC. ABC X ABC. That is the alternate right now. Otherwise, we come down, we put in a new low below here, and now I can start to fill our fibs in here. But to do that on the cash, then I'm going to have to redo it on the ES. So the cash market, I wanted to just basically go over all the background on why I believe we're in this, how long it's going to take, and what I compare the current move off of the January 2022 highs till now is very similar to 2000 to 2009. So if this is going to take as long as that, and it began in 2022, then the whole cycle really wouldn't be over until 2031, 32. Out there. It's out there. We're in the infancy part of it. We're still in that first leg down, the first larger leg down. In 2000, it was the dot-com crash. In 2023, 22, 23, it's interest rates. It's the dollar. It's all about what sits at the top of in control, interest rates. It's running interest rate policy for far too long, artificially holding it down. That is, you can go around and put that blame square on the Fed. And they did it. And now they're trying desperately to kind of keep it all together and take it all back. So we'll see. Okay. I'm going to go over to the S&P and to the futures market because it's still the same, but we're looking at something that's just a little bit different because it's a little bit more detailed in the future, because the future trades while the equity market, while the SPX, the cash market, is taking a nap or just resting overnight, etc. So here we have B, and then we have the 1 and the 2, the minor 1 and minor 2. And I still actually do believe that minor wave 2 is complete here. So, but what we have, same deal, right? 1, 2, 3, ABC, right? Because this turns into 1, 2, 3, 4, 5. Beautiful. But then again, I got a lot on this chart. I got to get rid of some of this. I can put it all back. The retracements, and I'll leave my extensions. I'll put these retracements back on. So what I got going on is that we had this great thing. We came in, and this would have been on the 7th. We made a nice low, put in that wave 3. We started a 4th wave. That 4th wave actually completed yesterday. I need to activate that and move it up just slightly so that's above this high right here. But ultimately, there's the A, there's the B, and there's the C. So it comes in again, and then they sold it off. And they sold it off. Remember, 4-hour chart, they sold it off pretty hard. And where did it come in? Bingo, came in the NASDAQ. The Dow continued to actually hold on. And let me just interject here. Out of all the indexes, this would be a good point. But before I go over in detail the S&P, the futures market, and then move over to the NASDAQ, I again want to show you the only index in my mind that actually still has the potential to put a new high in the sequence under a primary B wave. So we're in that intermediate C wave still. So that could be it there. And this could be a wave, the first wave down, just like the rest, but it doesn't count as cleanly as in the other markets. So here again, as we saw in 2008, 2009, the Dow all by itself went up and made a new all-time high. Now, this case, I'm not necessarily thinking that it's going to go up and make a new all-time high above all this. Let me go out to my weekly chart. But I do think it can get close. Now, here we have 35,689, but up here we have 36,700. This is 36,900. One can get as high as 36,700. That's pretty dang close, making this a very clean, flat A, B, and then we get a C wave, and that brings us back down to here in the Dow. So if anything, the Dow still has the ability, as it did on Friday when they were smashing, killing the NASDAQ, pulling the Russell down very heavily on Friday. They were rallying the Dow. Okay? United Healthcare. You know, we had, and then they went after Microsoft, and Apple was also a part of the Dow. But the Dow was up a whole lot more. But again, I wanted to make sure you saw that. One last thing I want to show. Let's take a look at the Russell. Again, this is Russell Cash. Primary A, so that's the 5, and that's also I'm marking as, as a cycle 5 as well. Cycle A, B, C, D, E was a triangle for the B wave, beautifully executed, and then bam, break down, coming out of the triangle. And let me put this down because what I'm finding is very interesting. You need to see what happened last week. There's the high on the 1st of September to finish minor wave 2. We had 3 strong, actually 4 in a row. And if I take this over and I look at, let's look at the cash NDX, or actually look at the cash SPX. They weren't all down days. Right? 1, 2, 2. Those 2 in the Russell were down. Oh, we had up days. So we're getting a little divergence between the markets nonetheless. But I wanted you to see that. So we have the NASDAQ, the Russell, and the S&P they're being basically in the same pattern, with the Russell now being more clear as to what's actually happening underneath. So over here, now let me go back down to the 4-hour chart. I apologize. So this is going to be a little bit longer of an update, but I think people have been asking for this greater detail, so I'm going to try to give that. So again, with reference to what would be the alternate here, it also would still be that wave 2, minor wave 2 is still in action. And what we got going on is, an ABC down, it gets labeled an X, and we're going to do an ABC, another ABC. This one doesn't favor that. The future doesn't favor that. It's not coming up like it's just going to keep going. This is very 3-wave in nature. We have a topping tail and a topping tail on the 4-hour chart. I can bring it down to the hourly chart, and here we have it again. What do we have? Tail, 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 tail. A lot of tails on the upside. So again, A, B, C, or ABC, A, B, C. Put the 4 there. 1, 2. not that great, doesn't look that good. It's not easy, but that's the best that I got. And so what that would suggest is that we start to drop. Now, our first calculation, if indeed minor 2 is done, which is how I'm marking it, and that we're looking for is a minor third wave. Well, third waves under Elliott, the longest and the strongest, most often the longest and the strongest. So I'm going to back out to the 4 hours so I can get a little bit lower here. All right. So what we got going on is the third wave should, without a doubt, break below 43.50. That's the low of minor wave 1. Minor wave 3 should take that out and not care and not look back after it's done it. Wave 3 would be equal to wave 1 at 42.64, but longest and the strongest. So what am I looking for here? Am I looking for it to be equal? It could, but it puts a whole lot of pressure on wave 5. Wave 3 cannot be the shortest out of 1, 3, and 5. Does not necessarily have to be the longest. It just cannot be the shortest. Well, it would be a real gamble to say, well, they equaled one another. They're not the shortest. 1 and 3 are the shortest. Don't know if that's going to work. So normally what I look for is probably 1.618. And that's still, we're above 4,000, folks. We're not like the world isn't ending yet. So 4,089 would be where maybe minor wave 3 comes in. Now, I'm telling you that out of this whole scenario, I think minor wave 3 is going to have to be bigger, right? I'm in a primary degree C wave, which is going to consist of 5 waves of intermediate degree. 1, 2, 3 minor, 4, and 5 puts our first wave, intermediate wave 1 into place. Is that going to come in here? Is that going to come in down here? And then we get an intermediate wave 2. So we still, even inside the cycle, which eventually should be taking us down towards 2980 to 3200, we've got 5 waves of intermediate degree, of which we're still in the very first intermediate degree down. And it may bring us down to 4,000. So will wave 3 get us maybe here, and then we do a 4 and a 5, and it's the 5 minor, and that's going to give us that intermediate wave 1, and then we get another intermediate wave 2 rally. This was a minor wave 2 rally. Take it up a notch. We get an intermediate wave 2 rally. So there are going to be some very strong rallies coming up. So when we're all trying to look at what's going to produce downside versus upside, somehow our brain is more accepting and say, well, we just keep going up and up and up. Markets always will correct, but they do so even in a downtrend. It corrects. That's why I call it. It would be an intermediate wave 2 or an intermediate wave 2 counter trend rally. So again, we're going to have decent upside. So, but over this near to mid term, I'm looking for this to come down into here, rally, and then come down again, probably into here, maybe a little bit lower, and then put in a bigger rally. How long is it going to take? Well, we're into September. By the end of September, not always the best month, folks. Go back and look at what September has created in the past. Some pretty strong downdrafts. So we get that strong downdraft, and it's what completes our intermediate wave 1. Then we've got October, November, because we always get what they call the October surprise, right? Because we're always looking for the market to crash. And if it doesn't and we go up, maybe it'll just be an intermediate wave 2. These can be scenarios. But again, we got a lot to cover before we get there. Okay, now back out, let's go to that daily. And what we're looking at on the futures basis, where does this thing line up? Well, we have 33.28. Now, mind you, right now, the Thinkorswim has rolled us out to the December contract, right? The September expiration is next Friday, but the Thinkorswim will be a little bit proactive and roll the contract out. And so we start trading the December contract. I likely will start trading the December contract on Monday, but the generalized rule that the market tends to pay attention to is as long as the volume is greater in September versus December, traders will continue to hang on and trade that September contract. But when the volume shifts and there's greater volume in December versus September, then everybody jumps and they'll be in that December contract, and that will happen prior to next Friday's expiration. So again, these levels we're going to have to apply to the December contract. So again, what we're looking at is primary wave C would be equal to primary wave A at 33.28. Okay. Well, it comes up next, 25.20. What do I have? I know I've got 3,200 and I know I've got 29.80. Those remain pretty consistent. Those will show up regardless of the contract. So now 29.80, 3,029.80, coming in a little bit cleaner here. Cycle wave A, very, very possible. All right, I'm going to go over to the NASDAQ then. Good news is, folks, I don't have to give much detail about what's happening all around us. Looking at the NDX, same deal. Cash market, I carried that through as long as I could, and now I've gone over, same deal. Wave one, broken, crushed, not necessarily crushed. So what I have is primary wave B complete in the NDX and the cash market, 15,960. Then we have minor wave one, minor wave two. Drop down to the 4-hour chart and minor wave one, minor wave two. Let's open it up and take a look at what we got going on. They got a few extra things in there. Let me take this guy out. So all I want to look at is what we got coming in for minor wave three. So again, a little bit different of a count, but I took out the middle here. So the actual Elliott labeling inside this third wave. I have a 1, 2, 3, a 4. And then we had that pretty solid get out of the pool drop. Now in Apple, here's what I want to talk about. Apple Computer. Apple had an expiration on Friday. When I took a look, the largest gamma positions were in the 180 strike. So it was for Friday's expiration, the 180 strike. So when the market started just prior to the opening, the US opening on Friday, you started to see Apple tick itself up, tick up, tick up, tick up. And it's like, okay, this is against the repeated news that, Apple, they're banning iPhone sales in China. They're not allowing people to own an iPhone. Well, that pretty much was why Apple went from 189 to 174. It just boomed. And I think it was 20 billion or even more. Lots of billions of dollars came off of the price. And when I saw them doing this on Friday, I'm like, wait a minute, what's really changed? If that is, and even though their big to-do, their big reveal of iPhone 15 and all this great change and all this other great stuff that's going to be being out on Tuesday, I believe it's Tuesday or Thursday. Are they starting to buy now because they believe that the sales are going to be raucous? They're going to really improve the bottom line for Apple, even when there's a lot of talk about, I don't know how many people are going to be standing in line to pay $2,000 for a phone, even though it's a smartphone, et cetera, et cetera. Why? Well, we're living in an inflationary period. Why? Because interest rates are higher, et cetera, et cetera. So things are going to cost more. Maybe they're going to hang on to that iPhone 14 a little bit longer. Or they're going to take the deal where they can pick up an iPhone 14 for nothing if you take these lines from Verizon, AT&T, et cetera, et cetera, et cetera. So yet to be seen. But by the opening, Apple is cruising towards 180. Now, if you understand zero DTE options and what can happen and where the gamma flow, right? If you got to, and I really don't want to go into the breakdown of what gamma represents versus the movement in the underlying. But let me just say that as they start pumping this market up and your gamma is exploding, it's usually because you're in the wrong position. And you're going to have to buy into strength, or if it's the reverse, sell into weakness. And that's what happens when gamma swings. And it's going to swing around the at the money option, which turned into the 180, which had the largest number of contracts coming in to expiration in both the put and the call. So you have both sides just really getting worked. So run it up to 180, and it's what they would call, they monetize that call, right? Because below 180, it's worthless. Then it's the put. Above 180, the call has greater value. So the premium on the way up to anybody who may be looking to monetize that call, you picked it up and you run the stock, or the stock runs, and you monetize it by selling it out. And then you're selling that premium because it got just above 180, which put it in the money, didn't last. And if you noticed, really, it got up there and then suddenly sold off $1. How often do we see that Apple gets hit hard enough where it moves and sells off $1 or more? But then they ran it up again, and then they ran it up again, and they sold it off, ran it up, sold it off, all the way to the end of the day. Then they just cracked it and whacked it, and it was the 180 put that became the hero. So that was the whole expiration deal, but that took place in Apple. And it also happened in the SPX. It happened in the ES. It happened in the Qs. So when you got this many things going on and force, you're going to get these huge swings. This one just happened to be courtesy of Apple. So it was easier to kind of pinpoint. Now, back to the NDX. If we're looking for at least 100%, we're looking at 14,244. Minor wave 3. Now, I'm going to go back out to my daily. And what we got is I got to put it back up there. Yep. So I got to go out one more to my weekly. And now I'm going to put in where for the NDX, what are we looking at on the primary C wave down? Well, primary wave C would be equal to primary wave A at 9607. So for the longest time, guys, I have not really been talking about it because we were in a rally phase, but we should go sub 10,000. And everybody thought, no way, no way, no way. While this is happening, I was like, okay, well, I just have to wait for that to finish. Doesn't mean that it's not going to if I get the move. The Elliott pattern remains the same. So 9607 is 100%. Where is 1.618? 56.99. I'm not looking for this deep right now, but it could. And what that suggests is something serious is going to happen. Something serious is going to pull a plug. Something serious. Now remember, going back to 2009, this move, right, the A wave of that cycle degree move was the dot-com bust. The B wave was just, hey, good days are here again. And the C wave was the financial collapse. What could it be this time? This is interest rates. Interest rate hikes, massive, consistent interest rate hikes. This was a recovery off of that with a lot of discussion, including one about right here, we're in a new bull market, et cetera, et cetera. But in essence, the B wave being the big fool, the big fooler, the big deceiver wave, what's changed? Are interest rates really coming down? No. Look at the bond market. They're telling you that rates are going to continue to go up. They will start to come down, but are we early? Are we counting on something that may not happen right now? Possibly. Is the Fed really going to pause and give us a break? Are they really possibly going to be done for 2023? And maybe they got one more coming in 2024 or something? Or do we get a pause for September? Because we have a September Fed meeting. And we have an October Fed meeting. So there's still things up in the air. And interest rates are back in the forefront. But I think we need to really consider what's going on around us and stop. And I have to share with you, read an article was presented to me that the bond market is out of sync with the equity markets. Well, I read that. I didn't need to go past the headline to go like, boy, they got that backwards. What sits at the top of that pecking order? Again, I'm going to just keep referencing it. Interest rates, that's what sits at the top. That's what produces everything. It's the cost of borrowing and the cost of carrying. You know, I lend it to you. This is what I'm going to get. I borrow it from you. This is what I got to do to carry whatever I'm doing. So again, that's the weekly. Wave 8 could come down that far, but we're going to have to wait and just kind of work it out as it works its way down. At least 100%, because that would definitely, wave C would put in a new low below wave A, and that's what we need. That low is 10,044, I believe, right? Yep, 10,440. And so 9607. So we're going to come back down. We're going to come back down to the 4-hour chart. I'm going to open that puppy back up. We get a wave 3, brings us down maybe into here. Get a wave 4, get a wave 5, and then we're just putting in intermediate wave 1. Intermediate wave 1 maybe here, maybe a little bit lower, and then we get a wave, intermediate wave 2 rally. This was the minor degree, and it was pretty good. It's like having an earthquake, folks. It's like the next degree, it's going to be 10 times. 10 times as strong. I'm not saying that that's how I'm going to equate intermediate degree to a minor degree, but you get the picture. It'll be bigger. So eventually, when we get 1, 2, 3, 4, 5 on an intermediate degree, and we're completing wave A on a cycle degree, I am going to be looking for somewhere down in here. So we got a lot of territory to cover. A lot. Let's go over and take a look at the NQ. And then I'm going to wrap this up, and I'm going to thank you for hanging out with me and listening to me discuss so much that people ask for. So I'm hoping, a lot of you may not really appreciate it, and I get it if you just kind of click off and say, forget it, I don't want to hear you. So I will include another update tomorrow, and it'll be much shorter, and it'll just be focusing on the hourly chart in the S&P, the ES, and the NQ for trading. All right, so here, what we got on the 4-hour chart, 1, 2, 3, I'm going to put a 4 there. I haven't, but I will. I'm going to wait and see what happens on the opening, and then we get a 5. And if that's the case, then I can give you a quick guesstimate on what wave 5. See if that did complete. Then we're looking for wave 5, minuet wave 5, right? It would put in a new low, because that's the low there is 15,158. And I'm looking, here's 15,147. That would fulfill it, but that's where wave 5 would be equal to wave 1, most common, 15,147. 1.618, next one down, is 14,997. And that one also can be a big high candidate to complete 1, 2, 3, 4, 5. But then it would just be minute wave 1 of minor wave 3. So I'm trying to be real careful. These are minute degree. This is minuet degree. This is sub minuet. So we're just finishing minute wave 1. Then we get a wave 2. Then we get a wave 3, and then we're coming down. So we still are looking for intermediate wave 1, and that's I think, down here. Then we get that bigger rally. In between, they're going to be smaller rallies, still very tradable, but just smaller rallies. Okay? So, moving averages. Let's go back and take a look, at least on this level. What is the the daily looking? Wow. See what we did? We came down, and this is going to be on the 7th. So this is Thursday. We came down and sat right on the daily 50. Bounced off of it, and we basically got ourselves back. We broke the 20, but we got ourselves back to the 20 to finish right there. So trust me, algorithms and traders understand what it could do to a market and how algorithms will adjust to what they think they need to do based on the position of those moving averages. So closing it above keeps hope for the buyers to step back in, or it could push it. And when it breaks that 50, same message, we start to drop. So my guess is that we'll likely break that 50. And then we'll get those additional signals for the sellers to continue to push. And we'll see what else happens. All right. Again, thank you so much for taking the time to listen to everything that I've been presenting. I truly appreciate it. I appreciate comments that have something to say. Either you're presenting your account, you're presenting why you may think it's different, and we're doing it in a conversational basis. Those are great. I really appreciate them. And it keeps me on my toes, and it keeps all of us on our toes and thinking. And that's the whole name of the game. So thank you for listening to this one. The next Elliott Wave update will be on Sunday, the 10th, once Globex opens in the afternoon/evening. Thanks again. Have a great weekend.